I'm always telling you that transports are one of the most important groups in any market because if goods are going to get sold, they got to be shipped first. Unfortunately, after a sustained move to the upside from 2010 through 2014, the Dow Jones Transportation Average has now stalled. It's down nearly 10% from its highs last November. And within the crucial group, the railroads have really been crushed, including the best of breed Union Pacific, UNP, which has tumbled close to 18% since making an all-time high in February. We know that shipments of oil by rail are down big, not really their huge business, but coal, another major cargo, also remains in pretty difficult shape. Plus, when Union Pacific reported a little more than a month ago, companies saw a 5% decline in intermodal shipping. Those are those big metal boxes that can go from container ships to trains to trucks. And when intermodal's down, that's generally not a good sign for our economy. But if you had to own a rail, I would pick Union Pacific. We got to ask ourselves whether the recent downtrend will continue, or does the pullback in the railroads represent the great buying opportunity, as it did when the company reported a tough quarter 4 years back? A lot of people bolted, and then the stock proceeded to triple. That's right, triple. That's why I want to dig deeper with Lance Fritz. He's the new CEO of Union Pacific. Hear more about how his company's doing and where it's headed. Mr. Fritz, welcome to Mad Money. Good to see you, sir.
It's so good to see you.
Yes,
Joe.
thank you so much, Lance. Lance, I got to tell you, Jack Korleski, we love, former CEO, chairman, came on and you basically just said, listen, don't worry. Things are going to get better. And the company had been in just one of those quarters where everything went wrong. I'm looking now, automotive up good, intermodal coming back, this for this quarter. But chemicals flat, ag down, industrial products down, coal down, intermodal. Isn't it entirely possible that this is what a bottom looks like? Because I'm not missing this one like I did in 2011.
It could be. And it is a difficult start to the year.
Right.
Last year was phenomenal. 7% growth. It was beautiful. This year, first quarter down 2%, and quarter to date in the second quarter down 4%. But we know how to deal with that.
Okay.
We've done this before. We know how to right-size the business. We're in the process of doing that.
Okay, so let's talk about the ones that could just be a bump, truly. A West Coast port strike, we know from so many retailers, was devastating. You got hit intermodal for that, right?
We did. International intermodal for us was pretty weak in the first quarter, but that was a bump.
Right.
That was a labor dispute. It had started in July of 2014. And as we stand right now, the backlog's cleared out, and the flow looks pretty normal to us from that business.
Okay, now, coal, in the conference call, you talk about how natural gas has gotten so cheap that there's a lot of switching. Natural gas could stay cheap for a long time, and the coal plants obviously discouraged by the government these days. Come back?
Yeah, we're hoping it comes back some. So if you go back about 10 years, about 50% of the nation's electricity came from coal.
Right.
Right now it's about 35. Natural gas is pretty volatile in its history. So all we need is for natural gas to get back to $3.50 or $4 a million BTU. And I think our coal business comes back a bit.
Okay, that's important. Now, when you talk about ag, it's been a tough year for the farmers. But that, again, is cyclical, right?
It is cyclical. We had back-to-back bumper crops. This year's crop is unknown, indeterminate, right? Will depend on the weather, whether the farmers are getting into the fields to plant. But it's a great business for us. We have a fantastic ag franchise.
Yeah, probably the best.
It's a beautiful one. We love it.
Yeah, and I just think that you have to buy that at trough. And then another one that I'm just trying to get my arms around would be the fracking sand, because that's really much more your bailiwick than just pure oil. And so and also there's obviously some steel involved with drilling. Oil comes back a little, maybe that comes back?
For sure. And you got it exactly right. If you look at last year's business, our shale energy-related business was about 4% of revenue.
Right.
About 2.5% of that was frac sand.
Right.
About 1% was crude oil. Frac sand is pretty important to us. And right now it is down. It came into the first quarter decelerating. We were still up 3% in the first quarter on frac sand. Right now we're down year over year. Okay. And this year could look a little bit like 2013 from that business. That's still a hell of a business.
Still a lot of business.
It's a great business.
Now, when I was on the KSU conference call, obviously very tough, up from Mexico. There's a gigantic Union Pacific railroad track that's a mile from my house in San Miguel de Allende. It's like you guys are operating 24 hours. Mexico, peso not so good, but that can change.
Absolutely. Mexico is such a great story from foreign investment, right? And we serve all 6 gateways to and from Mexico. Yeah. We have about 70% of the total rail to and from Mexico. It's pretty balanced. So when you look at the foreign direct investment that's happening there, I think their future is very bright, and it's bright for us.
Adding 500,000 car capacity in the next 18 months in Mexico. That will mostly be shipped by you, right?
We'll definitely have an opportunity to get our share.
Now, the one thing that is definitely going your way, a big tailwind, is that you guys are big users of fuel.
Yes, absolutely. The reason why we compete so well against highway truck is that we're about 4 or 5 times more fuel efficient. So that really doesn't matter what the diesel price is. That stays true all along. In addition to that, as the infrastructure in the nation's highways gets more congested, well, and as hours of service law kind of retard capacity there, we're a natural opportunity for companies to put more on freight rail and less on the highway.
Right. Now, you have always, read top of your comments, always talking about your safety record, which is superb. I know you had this Bell Plain, Iowa accident you just mentioned. There was no injuries last Friday, structural failure to one of the car's bodies. But there aren't a lot of derailments in the news. Are they happening more? I mean, you've got statistics. Sure. Or are they just getting more press?
They are definitely not happening more.
They're not.
Our experiences were 38, 40% better over the last 10 years on derailments. Our safety record is getting better and better and better. Our ultimate goal is 0, and I think that's achievable. And what we're trying to do is set records each year on that path. And we do things like invest in the infrastructure to harden it. We use technology to find defects before they find us. We train our teams and our craft professionals to be world-class operators, and all that's making a difference.
And you've also reinvested in the best and newest equipment. Is there enough money left to do some creative stuff with the cash for shareholders?
Yeah, we're balanced in our use of cash. You know that.
Yes, I am.
So we got a big slug that goes to capital investment. This year it's going to be $4.2 billion.
Right.
And then we also put some towards dividends to reward our shareholders, which have been growing over time. And we reward our shareholders through share buyback.
God, I tell you, I just know, I'm talking to a lot of my friends in the industry, and we just feel like we don't want to miss it again. We don't want to miss it again, because 2011 was that ultimate year. This could be the opportunity. That's Lance Fritz, the new CEO of Union Pacific, first time on CNBC. Mad Money's back after the break. Thank you, Lance.
Thank you.
Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.